President Donald Trump announced a 25% tariff on all car and light truck imports, claiming it would fuel American economic growth. But the move brought immediate trouble for Germany's biggest automakers. Companies like Volkswagen and Mercedes-Benz saw their first quarter of 2025 net profits plunge by more than 40%. Now, the financial spotlight is shifting, and it's directly on your wallet. Volkswagen responded by introducing an import surcharge on vehicles affected by the new tariff. The situation marks a turbulent chapter in global trade. In early 2025, Trump's tariff on German vehicles entering the United States disrupted supply chains worldwide. Automakers like Audi and Volkswagen paused shipments after April 2nd, citing rising costs. The impact was swift and severe. Import prices jumped, strategies were scrambled, and Volkswagen's earnings dropped 37%, falling from 4.6 billion euros to 2.8 billion euros. This decision didn't just rattle the market, it raised major concerns for US-EU trade relations going forward. When the tariffs were introduced, German car makers moved fast but kept quiet. Audi and Volkswagen halted exports of models like the Q5 and A6, leaving 37,000 vehicles parked at ports from Mexico to the Gulf Coast. This silence wasn't resistance. It was a cautious attempt to protect margins amid deepening uncertainty. With talk of tariffs going as high as 50%, the risk of sending cars to the United States became too great. This freeze triggered one of the sharpest declines in German auto exports to America in years. Key ports like Baltimore and Houston slowed dramatically while dealerships faced thinning inventories. Service centers, too, struggled with spare part shortages, relying on aging models to keep repairs going. What seemed like a short-term supply hiccup quickly grew into a clear example of how politics can upend commerce. The 37,000 cars stuck at sea? That's nearly 2 months' worth of U.S. inventory. Automakers didn't abandon the market. They paused shipments, hoping negotiations between Washington and Brussels would bring clarity. But as days turned to weeks, economic pressure grew. Audi dealers in the Midwest and Volkswagen showrooms in Texas ran low on key models, causing customer hesitation. This shipment freeze revealed just how fragile the auto industry really is. It wasn't a bold protest. It was a strategic step taken in silence. The decision to halt exports was about adapting to volatility, not making a political statement. At ports and distribution centers, the effects were immediate. Shifts were cut, jobs reduced, and storage lots left idle. Logistics firms struggled with delays and overflow, while automakers worked to minimize losses and delay tax hits. By May 2025, what began as a reaction to a tariff had evolved into a sign that car makers must now respond to a world where politics drive the market more than basic economics. Holding back tens of thousands of cars wasn't a mistake. It was a signal, a sign that the US is no longer a guaranteed destination for German vehicles. Shipping freezes have become necessary strategies, and as the pause drags on, the looming question is, when will it end? And what does this mean for global trade in the long term? Meanwhile, 37,000 unsold vehicles remain parked, a loud symbol of today's uncertainty. Audi and Volkswagen may be staying quiet, but the message is loud and clear. The rules have changed. The car industry must evolve or fall behind. To dodge tariffs, the auto industry has had to face a harsh new reality. Ever since Trump's 25% import tax began choking off German car shipments to the US, major players like Volkswagen, BMW, and Mercedes-Benz have been rethinking their manufacturing strategies. No longer relying solely on Europe-based factories, they're now looking toward North America, especially the US and Mexico. This isn't about expanding market share, it's about staying alive. With threats of tariffs rising to 50%, automakers are racing to keep their foothold in one of the world's largest car markets without bleeding revenue. Volkswagen is going all in, planning a massive United States factory, costing billions and taking years to complete. Experts say it's less about growth and more about long-term survival. By producing in the United States, Volkswagen can avoid import taxes, appease American regulators, and prepare for even stricter trade rules. BMW's approach is more adaptive. Their large South Carolina plant already builds SUVs for global buyers, and now it's ramping up production. But honestly, even extended shifts can't fully replace the output of European factories, leaving BMW exposed to risks during this transition. Mercedes-Benz is taking the long view, planning to build its GLC SUV in Alabama, but not until 2027. Until then, the company must endure rising costs and delays. It's a long wait in a fast-moving crisis. This shift to North America is a historic moment for German automakers. For decades, cars were built in cities like Munich and Wolfsburg and shipped globally, all thanks to stable trade deals. That model is now obsolete. Today, building cars means navigating a world where politics can disrupt commerce overnight, and the cost of adapting is sky high. New plants mean buying land, hiring workers, getting permits, and constructing everything from scratch, a process that can take years. Volkswagen's United States plant alone will cost billions before a single car is made. BMW and Mercedes face the same financial strain as they expand their operations. On top of that, they must meet United States regulations, adapt to local labor laws, and train workers to meet German production standards. Then there's the issue of currency risk. A weaker dollar could wipe out profits. With every step, automakers must balance speed, quality, and cost, all while trying to stay competitive in other regions. The pressure is building. BMW warns it could lose 1 billion euros if trade tensions persist. Volkswagen is equally concerned and is accelerating its United States plans to be ready if tariffs increase again. Mexico is another option. Thanks to trade agreements, goods can move to the United States without tariffs. German automakers already operate plants there, but the move is risky. The United States government could crack down or change the rules, turning Mexico from a solution into a new problem. Each path comes with trade-offs. Building in the United States earns goodwill but costs more. Mexico is cheaper but politically tricky. Staying in Germany maintains quality, but the tariffs are brutal. Doing nothing is not an option. These automakers know one thing: they can't afford to wait. As 2025 races on, they're not just solving today's issues. They're planning how to survive the next era of global trade. The traditional ways of designing, building, and selling cars are fading fast. Global trade is no longer simple, and politics now plays a central role. The shift toward production in the United States and Mexico reveals just how serious the situation has become, and how much the global auto market is likely to change in the years ahead. Markets briefly surged when President Trump announced a delay in the next round of tariffs on European goods. Shares of German automakers saw a mild lift, suggesting some short-term relief. But behind the scenes, caution remained. Volkswagen and Audi didn't rush to resume exports. Instead, they kept vehicles on hold, waiting for signs of lasting stability. This cautious stance stemmed from deep concern about unpredictable trade policies. The delay in tariffs felt more like a temporary ceasefire than a meaningful breakthrough. A phone call between Trump and European Commission President Ursula von der Leyen offered a pause, but no solid agreement. Key issues like market access and regulatory standards remained unresolved. Automakers saw this clearly, not progress, but a tactical pause. U.S. ports, once filled with high-end German cars, fell silent. Places like Baltimore, Houston, and Charleston saw traffic slow dramatically. Dock workers faced fewer hours. Shipping companies had to redirect cargo, often to Mexico or Asia, driving up costs for storage and logistics. Customs brokers began advising clients to offshore high-value vehicles, a strategy usually reserved for luxury goods, now applied to mass-market cars. U.S. dealerships, too, felt the pain. With fewer new arrivals, popular models like the Audi S6 and VW Tiguan became scarce. Salespeople struggled to hit targets, commissions fell, and customers faced delays or limited choices. In cities like Chicago and Miami, dealerships reported up to a 50% drop in new deliveries. Some resorted to leasing older models or discounting unpopular trims. Others tried sourcing inventory from Canada, a workaround that proved costly and complex. Customs data painted a stark picture. German car imports to the U.S. fell 23% year over year. The issue wasn't demand, it was caution. Automakers simply weren't willing to send vehicles into a market where rules could change overnight. More than 75,000 European-made cars were left in storage or in transit, many rerouted to Canada to delay customs fees. Others were diverted to smaller ports to avoid detection and penalties, a trade war tactic now mainstream. Service departments were hit too. Fewer imports meant fewer parts. In Texas, mechanics ran out of essential components. Some dealerships even salvaged parts from unsold vehicles just to handle urgent repairs. A once smooth supply chain was now held together by stopgap solutions. In Germany, manufacturers scaled back. BMW cut summer shifts in Bavaria, while Volkswagen offered early retirement packages to avoid layoffs. Mercedes-Benz canceled a hiring event in Stuttgart, hinting at a broader freeze. These weren't isolated adjustments. They reflected a larger trend. The industry was no longer driven purely by consumer demand. Geopolitical risk now shapes production. Forecasts are reviewed cautiously. Hiring is on hold. New model releases are pushed back. Analysts describe this as a silent contraction, not mass closures, but a slow retreat from previous growth plans. Volkswagen announced a 10% production cut for the second quarter of 2025, calling it temporary, though internal sources suggested it could last longer. Other manufacturers are expected to follow suit. The effects go well beyond the factory floor. Suppliers, logistics firms, and communities dependent on auto jobs are bracing for more cuts. This shift isn't driven by a single leader or policy. It's, a fundamental reassessment of global risk. Exporting to the United States, once a reliable business model, now comes with deep uncertainty. German automakers are rebuilding resilience into every part of their operations. The tariff delay offered a brief moment of relief, but not real security. It's just a pause in a long-running conflict. Automakers aren't reacting only to today's headlines. They're preparing for a world where trade rules can shift instantly. Frozen shipments, reduced output, and supply bottlenecks all point to a sector in transition. The road ahead is unclear, but one thing is obvious: the old ways are gone. The car industry's struggles today are a cautionary tale for others. Should tariffs linger, electronics, machinery, and more may face similar issues. What's happening with cars now could reshape other industries tomorrow. Germany's automakers are entering a new era, one defined by adaptation, not defiance. Technical excellence alone isn't enough anymore. Political strategy is now just as important. This isn't protest, it's survival. A shift meant to ensure long-term relevance in an unstable environment. As tensions rise between the United States and the European Union, German car makers have learned the hard way. Politics now outranks technology in shaping their future. The evidence is everywhere. BMW has increased production at its South Carolina plant, signaling a long-term pivot to American soil. Audi is exploring new operations in Mexico to broaden its manufacturing base. These changes go deeper than factory locations. Automakers are adjusting pricing strategies and re-engineering supply chains to blunt the effects of trade volatility. It's a clear sign. The industry is aligning itself with a more politically driven world. And the timing is critical. A major deadline looms, July 9, 2025, when United States-European Union trade talks will determine whether a new agreement can avoid a full-blown tariff war. The outcome could deeply influence the next chapter of Germany's car industry. Yet, even if a deal is struck, the long-term direction is already set. Automakers are investing in United States-based operations, not just as a short-term hedge, but as a durable solution. It's costly and time-consuming, but it signals commitment to a future where global uncertainty is the norm. In the end, the ability of Germany's car industry to weather this storm will define its next era. The strategic changes now unfolding are not temporary patches. They are the foundation of a new model. As the world watches for the results of this pivotal negotiation, one truth remains. Adaptability isn't optional, it's survival.